The biotech industry is at an inflection point. For nearly a decade, Boston has been the global biotech capital, synonymous with thriving startups, full lab spaces, and top-tier talent. But the golden age may be coming to an end. Lab vacancies are rising. Southern U.S. cities are accelerating their biotech infrastructure and incentives. And the "for how much longer" has gone from rhetorical to strategic. California, too, is showing early signs of a parallel drift. High operational costs, market saturation, and emerging opportunities elsewhere are driving a similar shift. This brief will cover the predicted trajectory of the Boston and California biotech ecosystems over the next 3 years, as well as the top 5 CDMOs in the southern U.S. that are likely targets for acquisition. 1. Boston, Massachusetts outlook. We estimate that over the next 3 years, approximately $7 to $10 billion in lab and real estate assets will be written down as companies exit or scale back on their operations in Massachusetts. As a result, we expect up to 20% of the current STEM and biotech workforce in Massachusetts to be lost by 2028. Over the same period, we forecast for $0.2 to $5.5 billion in venture, private equity, and institutional capital to be redirected away from Massachusetts to lower cost, higher growth CDMO hubs in the U.S. Southeast, too. California parallels. Signs of a similar trajectory in California include a 15 to 18% lab vacancy rate in the Bay Area as early as Q1 2025, as well as the exit of several mid-sized biopharma firms from Los Angeles to Texas and Colorado. Over the next 3 years, we estimate that $6 to $8 billion in operational and growth capital will move out of California to states with less regulatory overhead and more competitive incentives. 3. Southern CDMO rise. We project that North Carolina, home to Research Triangle Park, and the strong academic institutions in Durham and Raleigh will attract $2.1 billion in new capital over the next 3 years. In Texas, Houston and Austin are expected to attract $1.4 billion in new capital, while Salt Lake City, Utah is forecast to receive $800 million in new capital through 2028. Atlanta and Augusta, Georgia, and Orlando and Tampa, Florida are also expected to be strong recipients of capital over the next 3 years, with Atlanta and Orlando receiving $600 million and Tampa receiving $450 million respectively. 4. Top 5 agile Southern CDMOs for acquisition. Given the head start that Massachusetts-based companies have in building out their operations, we believe that the most likely targets for acquisition will be those with advanced development capabilities and scalable infrastructure. KBI Biopharma in Durham, NC, is an attractive target given its strong biologics development pipeline and good manufacturing practices manufacturing capabilities. Similarly, the Thermo Fisher CDMO unit and its Greenville, NC site is an industry-grade GMP site that is ready for integration and leverages the resources of an acquisitive conglomerate. Arranta Bio in Gainesville, FL specializes in microbiome and live biotherapeutics, an emerging vertical that could help expand the therapeutic capabilities of a strategic beer. CTD in Houston, TX offers a hybrid model with expertise in small molecule and biologics as well as an agile, private equity-backed platform that could help drive efficiencies and growth. Locus Biosciences in RTP, NC offers an attractive platform with precision antimicrobials and a CRISPR-Cas3 gene editing platform. This would be an attractive target for a firm looking to acquire a platform technology through horizontal integration. 5. Preferred acquisition and integration models. Our analysis suggests that the most likely route for CDMO acquisitions will be through vertical integration. In this model, large MA-based players such as Moderna, Biogen, and Vertex will look to control downstream operations and manufacturing timelines to reduce risk and accelerate development. We expect these firms to prioritize in-house GMP capabilities, end-to-end control, and regulatory compliance efficiencies over cost savings. However, select firms may pursue horizontal integration through acquisitions and platform consolidation, particularly those investing heavily in biologics or novel modalities such as gene therapy to broaden their therapeutic capabilities. We also see contingent value rights or CVR mechanisms as a suitable option for acquiring early-stage CDMOs or platform companies. This approach enables risk-sharing and milestone-driven payouts, making it attractive for unproven but high-upside targets such as Locus or Arranta. Strategic recommendation: Massachusetts-based biopharma leaders must act decisively to avoid losing their competitive edge. Reevaluate and optimize asset utilization. Consider offloading or repurposing idle lab space. Pursue strategic CDMOs in the South with an emphasis on integration models that align with core R&D and pipeline strategies, and adapt compensation and talent strategy to counteract the migration of skilled workers. This can be achieved by offering hybrid work arrangements, competitive incentives, and fostering partnerships with Southern academic and biotech ecosystems. Finally, influence policymakers to push for biotech-friendly tax, zoning, and funding frameworks to ensure that Massachusetts remains a premier destination for biotech innovation.